So now we have covered the effect of the exercise price on the value of the call, and we are saying that for a European call, the price of a European call that has an exercise price of X1 will always be greater than the price of um, a European call that has an exercise price of C2. Any other good reason why this should be the case? I mean, we did talk about the technical details of this. The right to buy at a low price should always be more expensive than the right to buy at a high price, keeping other things constant, isn't it? It's a very simple principle. That is, the right to buy at low price should always be valued more than the right to buy at a high price. Okay, that's a simple logic. However, we just saw it technically when we were talking about the portfolio A and portfolio B payoffs. Okay, now we also said that the price of C1 will be equal to or greater than. So when will it be equal to? Again, it will be based on the deep out of the money or deep in the money thing. Okay, so if an option is deep in the money or deep out of the money, that will also affect the effect of the exercise price on the value of the option. So whenever the option is deep out of the money, we will see that the value of the C1 will always be equal to the value of C2. Why? Because for a deep out of the money, the intrinsic value will be zero already because it is deep out of the money, and the time value of money will also be zero because there is no interest in it, and even the time is not useful because there is very little chance of the option getting into the money because it is deep out of the money. So whenever the option is deep out of the money, it will have zero intrinsic value and zero time value of money. In such a case, C1 will be having a value of zero, so will C2 have a value equal to zero. So that is why we have this equal to sign here along with the greater. The deep out of the money, I mean, like when the case is deep in the money, we will see that when it is deep in the money, C1 will always be valued more than C2. You see, I said that for deep out of the money, C1, for deep out of the money, C1 will have intrinsic value 0 and time value of money equal to 0. C2 will also have intrinsic value 0 and time value of money 0. So C1 will be equal to C2. If it is deep in the money, what will happen? C1 will have intrinsic value, but its time value of money will be 0. C2 will have intrinsic value and its time value of money will be 0. However, we know that the intrinsic value of C1, let me call it 1 and this called C2. The intrinsic value of 1 will be greater than the intrinsic value of 2. That is, the maximum of 0 and S0 minus x1 will be greater than the maximum of 0 or S0 minus x2. And that is where I told you that the right to buy at a low price will always be valued more than the right to buy at a high price. Have a look here. For example, 125.94 minus 120 and 125.94 minus 125. Just the example of our DCRB calls. So this call that has an exercise price X1, which is lower than X2, has an intrinsic value of 5.94, and this option, call option, that has an exercise price of X2, it has an intrinsic value of only 0.94. Next is another important related concept, and that concept is, as we discussed a few minutes ago, that the portfolio B is always dominating portfolio A, and it is that the portfolio A has a value greater than portfolio B. So we see that portfolio B is either equal to A or greater than A. We saw in situation 1 and that the portfolio A and portfolio B were having the same payoff. But in situation number 2 and situation number 3, we saw that portfolio B was dominating portfolio A. So that is why we see that portfolio B will always have a value greater than portfolio A. And we also concluded that C1 will always have a value greater than C2. That is, the right to buy at X1 should be more expensive than the right to buy at X2. Okay, keeping other things constant. That's what we concluded there. We have concluded that C1 should be greater than or equal to C2. This has an exercise price of X1 and this has an exercise price of X2, and other things are equal. Now the question is, what can be the maximum difference between the prices of C1 and C2? You know, we said that C1 should be more expensive than C2, but how much? So technically, the difference between C1 minus C2 should not be less than X2 minus X1. That is the difference between the exercise price. So in our case, the example that I gave you for the calculation, we saw X2 was 130 and X1 was 120. So the difference was 10. So the prices of C1 and C2, you know, they can be equal to, the difference between them can be equal to or less than this. Okay, but it cannot be greater than this. So it is possible that we have this equal to 10. It is possible that we have this equal to 8. It is possible that we have equal to 3. But this is not possible that we have X2 minus X1 equal to 10 and C1 minus C2 is equal to 15. If this happens, again, there will be arbitrage, and we know how the arbitrage works. Why I am not saying that the difference between these the C1 and C2 should be like this: X2 minus X1 into 1 plus R raised to the power minus T should be greater than or equal to C naught, let me make it European call, C1 S naught T and X1 minus C, the European call with the stock price equal to C S naught T and X2. This is the expression we learned from the portfolio A and portfolio B payoffs. However, I am saying that X2 minus X1 is what I'm going to use to reflect the difference between the prices of this C1 and this C2. Why I'm not putting in this? Because you know that X2 minus X1 is greater than X2 minus X1 into 1 plus R raised to the power minus T. So I am saying that the difference between the prices of these two calls cannot exceed the difference between the exercise prices. Okay, the difference between the call prices cannot exceed the difference between their exercise prices. The question is, I used European call for explaining all this. I did not use the American calls here. So why? What is the reason? So let me take you to the same example that we did earlier. And let's say we have portfolio A here and portfolio B here. And we have C1 and C2, and I have a long position in C1 and I have a short position in C2, and this one is X2 minus X1 into 1 plus R raised to the power minus T. Okay, and this is T naught. Let's make it T1, and this is T naught today. And I'm not going to talk about the three positions here. I'm just going to talk about the position where we can exercise both the options. So let's suppose here on at expiration, let me just say at expiration T. At expiration, let's suppose if this is, let me just clear this. Let's say T is here. Okay, this is expiration. If it is an American call, what can happen if this situation is the case before expiration? You see, this is the expiration, because the American calls can be exercised at any point of time. And let's suppose before the expiration, this thing happens where the stock price here before expiration, let's make it small t, so that means before expiration, but after the contract is initiated. Let's suppose today is 1st January, okay, and this is 31st December, and let's suppose this is 30th June, okay, halfway. So the option is in the money. Both the options are in the money. So if I exercise, and these are American options, so if I exercise my option, I will get what? I will get ST minus X1. And the counterparty will also exercise its right, so it will receive ST and I will get X2. So if I look at it, my net payoff is ST crosses, so I get X2 minus X1. If I get this money here on 30th June, what will I do? I will invest this money for the next 6 months, where I'll be investing this for T minus T period. That is 1 year minus 6 months, so 6 months. And what will I get here? I will get X2 minus X1 into 1 plus R raised to the power T minus T. This is the amount I will receive here, because I got this money and I invested it for next 6 months at risk-free rate. Now, what is the payoff of this portfolio? This payoff will always be X2 minus X1. Now you can see that this is greater than this. In such a situation, what is happening? Portfolio A is dominating portfolio B. If it is a European call and the options become in the money before expiration, both the options will be exercised and I will receive a net payoff of X2 minus X1. I will invest that at the risk-free rate for the remainder time, and at expiration, my payoff from portfolio A will be this, which will be greater than X2 minus X. In this case, what is happening? Portfolio A is dominating portfolio B, and hence it violates what we learned about European calls in our previous analysis. So that is why we say that we cannot apply the same concept with American calls, because the American calls can be exercised anytime prior to expiration. And if this is the case, there is a possibility that at expiration, I will have a payoff that is greater than what I will get with portfolio B. And what we learned previously, that portfolio B's payoff was greater than or equal to portfolio A in all the 3 cases. Now here we see that for American calls, what is becoming possible is that portfolio B's payoff is less than portfolio A. There is a way out, and I have extended the slides here. And when you are reading the book, I have also uploaded the errata, the book errata on Moodle's site. There is a typo error. If you go to page number 80 and the last paragraph of the second last paragraph, that is the 3rd paragraph, this is this term there is with a minus t. So that is not correct. It is with a plus t. And you can find all the errata on the Moodle. I have uploaded it there. So to overcome this problem that we have discussed, previously we said that portfolio A and portfolio B. Portfolio A is consisting of the call option that has an exercise price of C1, and portfolio B has an exercise price of C2. And we have a long position here and we have a short position here. Portfolio B was invested X2 minus X1 into the risk-free securities. So that was the price of the risk-free bond equal to this. If we have this for American call, we are always going to have that problem where if ST is less than X2, which is also less than X1, in such a situation we saw that it would result in a possibility that at the payoff, that is at expiration, what is possible, we may have X2 minus X1 into 1 plus R raised to the power T minus T. which will be greater in value than what we will get for European call for portfolio B, X2 minus X1. So to avoid this situation, and if you still want to prove what we have talked about for European calls, what you need to do is that you need to say that you are having the face value of the bond equal to, the face value of the bond is equal to this X2. Let me just write it again. So you want to say that the present value of the bond, that previously we said that it was equal to X2 minus X1 into 1 plus R raised to the power minus T. That is what we said. But for European calls, if you want to prove the same thing, that is C1 should always be more than in value than C2. If you want to prove this, then you have to actually change this here, and you are going to say that the present value of the bond is equal to X2 minus X1, which means that the future value of the bond will be equal to X2 minus X1 into 1 plus R raised to the power plus T, not minus T, that is T. So if you drop this and you take the present value of the bond equal to this, then the face value of the bond will be equal to this. In such a case, then portfolio B will still be dominating portfolio A, and you can say that for American calls, the rule also hold where C1 is greater than or equal to C2. So you have to make an adjustment in the present value of the bond price. Previously, you were saying that the present value of the bond price is equal to the difference between the exercise prices multiplied into 1 plus R raised to the power minus T. That is the present value of this. Now you are saying no, the present value of the bond is equal to the difference between the exercise price, and the future value or the par value will be equal to the X2 minus X1 into 1 plus R raised to the power T. So if you do this, then in all the three possibilities that we discussed, nowhere it is possible for portfolio A to dominate portfolio B. These are subtle changes and variations. You have to be very careful about it. That's why I told you have to start reading and read very carefully. As you start reading the chapters, you will see that as you move forward, they are getting trickier and trickier with detailed, minute variations in concepts. So we need to be very sure that we are reading the book and the articles. If you don't do that, then for the exam and for the coursework, it will trouble you. And I tell you, this module has value that goes beyond its assessment or evaluation value. It's something that is quite rarely taught on finance module, that is option pricing and derivative pricing and valuation theory, because we know in risk management and other modules you are just using them, but you don't know how the price comes and what are the limitations. If you know all this, you are quite good. You're at the same level as somebody is doing an FRM or a CFA or any other professional or academic qualification, because this is where how far it can go. And the good thing is it's still not that mathematical. I mean, we are still not doing hi-fi level of any mathematical calculation like calculus or linear algebra. We're not doing that. When we started, we said that the minimum value of a European call or of an American call will be its intrinsic value. So we said for American call, the minimum value is its intrinsic value, which is equal to the maximum of 0 or S0 minus X. And we said this is because the American call can be exercised at any point of time before expiration. So the intrinsic value of concept is applicable to it. But we said the same is not applicable for European calls because they are not early exercisable. So what is the alternative then for European calls? So I was talking then about lower bound value of a European call. So here we are talking about the lower bound value of a European call, which is how little the value of the European call can be. So let's look at again the portfolio, which we have. Again, we have two portfolios, and this time portfolio A is if we have a long position in the underlying stock, and if we create a portfolio where we are having a long position in the call option and we have a long position in the risk-free bond, and the risk-free bond here is equal to the present value of the exercise price. So it is again a zero coupon bond where we are investing the present value of the face value in the risk-free bond. At maturity, we will get X. Okay. So again, if I just create my own calculations here, let's suppose we have portfolio A and we have portfolio B. Portfolio A, we are going long the stock, and let's suppose the stock today is worth $100. Okay, and we are going long the call, and the call gives us the exercise price. Let's suppose the exercise price is 100. Okay, and the risk-free rate is 5%, and the time to expiration is, let's suppose, 1 year. So we are going long the call, and we are investing in the risk-free bond, which is X into 1 plus R raised to the power minus T. So if I do this, I don't know the price of the call yet, but we can calculate the value of the bond, which will be in this case equal to 1.05 raised to the power 1 multiplied into 100. So that is equal to, this one is equal to 95.24. We don't know the value of this yet. Okay. So if we create these two portfolios, portfolio A is invest in the underlying asset, and that is $100. Portfolio B is buy a call option and then invest in the risk-free bond. In future, there are two possibilities. At T, there are two possibilities. ST can be less than X, or ST can be more than X. Okay, so if ST is, let's suppose, let's make it ST is equal to 120. Okay, and then ST is 80. Okay, so if ST is 120, what will happen? This portfolio will always give you ST, because the stock price you purchased for 100, the stock you purchased for 100 is now worth 120. So this is the same. Situation number one. Situation number two, if it is less than 100, more than 100, sorry, this one will be 80 and this will be 120. So if it is 80, it will be 80 here. And if it is 120, it will be, ST will be worth 120. Because this is the share that you purchased, the price going up or going down will directly affect the value you have for the stock. The call option here, if ST is less than X, if the stock can be purchased in the market for $80, will you buy it for $100? No, you will not. So you will not exercise your call, so your payoff from the call will be zero. And what you will get from the bond is a risk-free investment, so it will mature to its par value or face value. That will be how much? X. So X will be equal to, X we already know is 100. So X will be equal to what? 100, isn't it? That's the payoff of this portfolio. And then if ST is 120, we see that the call option will be in the money. In that case, what you will do, you will exercise your right. You will buy the call for, we will buy the stock for 100. So you will pay 100. Okay, that is your X. Okay. You will pay this, so minus sign, and you will receive the stock from the seller of the call. So that will be ST, which will be worth 120. And here, what you will have, from where will you get the $100 to pay to the writer of the call? This 100 will come from the investment you have made in the bond. So you will get X 100 from the bond. So now, if you look at what you have, you needed $100 to exercise your right. So you use the money that you received from your investment in the bond. So this crosses with this. So the payoff from this portfolio is ST, which is 120. The payoff from this portfolio is also ST, which is 120. In this case, the payoff from this portfolio again is ST $80. However, the payoff from this portfolio is X, which is $100. So you can see portfolio B is always dominating portfolio A, or is equal to portfolio A, but never less than it. So what we are saying here is that buying a call option plus investing in a risk-free bond will always be valued more than or equal to buying the stock, which is portfolio A. You see why we are writing this relationship? Because in the first case, portfolio B is having higher value than portfolio A. So this greater than sign is reflecting that. And in this case, the second situation, we see portfolio B has a payoff that is exactly equal to what we get from A. So we have the equal to sign. Now, this is what we find from our analysis of the valuation. Now, our question was, what can be the price of a European call? The lower the value it can go. So we see if we rearrange this, because it is an inequality, we can rearrange it like this. Look, the price of a European call, or the lower bound of a European call, will always be greater than or equal to the spot price minus the exercise price into 1 plus r raised to the power minus t. It's just like an inequality. So you change it and you get the lower bound value of a European call. So in no case, the lower bound value of a European call will be less than this expression that we have here. And if we just formalize it, we can write it that the lower bound value of a European call, because we know that it cannot be less than 0, will always be greater than or equal to maximum of 0 or S naught minus the present value of the exercise price. So this is just the same as we have here symbolically represented on in figure table 3.5. So let's go back to where we were. So we now have the lower bound value of a European call, which is equal to this expression here. Remember, we said that the intrinsic value concept is only exclusively applicable for American call. And we said that the lower bound value of a concept is for European call. Now remember, an American option or American call is capable of what a European call can do. However, an American call goes beyond that. For example, I would say the American call and the European call are different in terms of the options they have. So the European call gives you the right to buy. Okay. The American call also gives you the right to buy. However, the American call also gives you an extra option that you can exercise early, which is not available here. So that is why an American call is capable of doing whatever a European call can do. However, it has extra options embedded in it. That means that though the intrinsic value concept is applicable only to the American call, if somebody asks you what is the lower bound value of an American call, you should always say that it will always be equal to the lower bound value of a European call. And why we are saying that? We are saying that though the American calls are exercisable early, nobody will exercise the American calls before expiration, except certain exceptionally you can say challenging or the amount of dividend when it is quite high. Okay, though on the slide here it says that whenever there are dividends, it may force early exercise, but that is not always the case. Okay, so though the American calls will enable you to exercise early, the investors would not exercise their calls early. Why? Why would not that be the case? Any suggestion? Why would not an American call be exercised early? I said lower bound value of an American call is equal to lower bound value of a European call. And I said normally the American calls will not be exercised early. Why? Because if you exercise your American call early, you and I now know that the value of a call is, or an option is, composed of intrinsic value and time value of money. So if you exercise your call, you will only receive the intrinsic value and you will lose the time value of money. We know that the American call gives you the right to exercise early or at any time prior to expiration. Now, just imagine you purchased an American call where you have the right to buy at 100. Okay. And when you were purchasing this right, at that point, the share price was 100 also. Now, the share price has gone up to $180. And there are still 1 month, 2 months left to expiration. If you exercise your option right now, you will get only 80. Okay. And normally in such circumstances, you see the option, because it has an intrinsic value of 80, it will also have some time value of money. So the call price in this case will be more than the intrinsic value. But if you exercise it, you will only receive $80. So you will never want to exercise your right before the expiration. Can anyone tell me why now? You will lose time value of money. That is the first thing. Okay, understood. The next thing is you lose the right to decide later, because if you had waited, might be the share price have gone up to 250. Might be it would have gone up in the next 1.5 months to 300. So if you exercise it right now, you lose these probabilities. Now somebody can say the share price can go down to 90 or 80. Yes, it can go down. But remember, in derivatives world, we are in a risk neutral setting. So we are more concerned with this rather than with this. Why? Because the maximum we lose in a call option is the call premium we have paid, isn't it? So our payoffs are asymmetric. So we know that the maximum we can lose is the call premium, and our gains are, like, theoretically unlimited. So that is one reason. The other thing is, when you give up, let's suppose you purchased an option that will expire in 6 months and you exercise it after 4 months, you are basically lending your call premium 2 months in advance to the call writer, theoretically speaking, who can earn interest on it. As you will read the book and the related text, it says that a dividends will affect the price. We know, and you know, that when companies announce dividend, when companies announce dividends, what happened? They give you the X dividend date, okay, and there is another date. What is that other date? Holder of record date. Okay, so normally in markets, what happens? For example, if a company announces dividend today, let's suppose today is 9th of Feb. Okay, so it says that the stock will go X dividend. Let's suppose it's 9th of Feb. Okay, and the holder of the record date will be, let's say, 10th of March. Holder of record date. That is 10th of March. So that means the stock will go X dividend on 8th of March. What does this mean? If the company has announced, let's suppose, a $5 dividend per share, and if I buy the share before till 8th of March, my name will be, or I will be eligible to receive the dividend. Okay. Why? Because if I buy the share on the 8th of March, I will become the holder of the record date on the 10th of March. If somebody buys the share on the 9th of March, the share will be trading X dividend after 8th of March. So whoever buys this share after 8th of March will not receive the dividends. So I will be the holder of the record date and I will receive that dividend. Whenever this happens after the X dividend date, the share price, for example, if here was $55, the next day, theoretically speaking, not practically, the share price would fall to 50. Why? Because the $5 dividend that was included in the price here before X dividend date, whoever buys the share after 8th of March will not receive that 5. So he or she will not be buying it at a price of 55, but at a price of 50. So this will reduce the price. And remember, there is a positive relationship between the call price and the stock price. So if the stock price goes up, the call price goes up. If the stock price goes down, the call price goes down. So dividends, because they affect the share price negatively, they will have a negative impact on the call price. For the put, it is the opposite. Okay. So the put price will go up if the stock price goes down, and the put price will go down if the stock price goes up. Okay, so there is a negative relationship. So dividends will be favorably affecting the put prices, but they will be negatively affecting the call prices. Is it clear? Now, if you have to price a call on a stock that will pay dividends, so what you need to do is calculate the present value of all the dividends that will be paid between the time you purchase the call option and the time the option expires. In our case, for example, if you purchase an option on the 14th of May and your option is expiring on 21st May, and the stock will pay the stock will become X dividend, let's suppose on the 17th of May. So what you will need to calculate is calculate the present value of that dividend and deduct it from the stock price, which will result present value of dividends. This will result in an adjusted stock price, which we will write like this with a hash or a star on it. So this price will then be used in calculation. And when we move into chapter 4 and 5 of your Chance and Brooks book, we will see that there we will be adjusting the stock price for dividends as and when they become due during the option lifetime period. I will leave this to you. We have already discussed this interest rate parity theory in international finance, and I have some videos coming in futures and forwards. We will talk about it later, but just forget about foreign currency calls and puts for this time. Okay, we are focusing just on stock. If we look at dividends, you see, I said that dividends will affect the call price negatively. Okay, so there is a negative effect of dividends, because dividends will reduce the share price. We will have to adjust the share price, and when we adjust the share price downward, then the call price will also go downward. And this is one of the situations, the extreme situations in which a call will be exercisable. It will not be if it is an American call, you will not want to wait till expiration to exercise your right, but you will want to. However, we will see, particularly in binomial option pricing model, that it will require a very huge amount of dividend on the part of the company, so to force you to exercise. For example, if your call option is right now trading for 8.75, okay, and the company declares a $2 dividend, you may not be exercising your call option. Though, if you look at the journal literature, it says, well, dividends affect share price negatively, and that have a negative effect on the call price. So if it's an American call, it may be exercised, but it's hardly exercised because the dividend required needs to be so high, so to force conversion. And the reason for that is that the present value of the dividends should be so high that it is greater than the value of the interest you lose on the exercise price. Any idea? I say the present value of the dividends should be higher than the present value of the interest you will lose on the exercise price.
What do you mean by interest on exercise price?
Yeah, it's interesting, isn't it? That takes us to the next discussion we have on the relationship of interest rates and call prices. Okay, so if I go to that, yeah, it's here. But let us discuss this first, and then we will just there have a look at it again. Have a look at this. If you have $100, okay, that is your investment. You have two options, okay, option A and option B. Option A is to, let's suppose, buy a stock that is currently trading for $100, okay. Option B is to buy a call option on the same stock for let's make it $5, okay, and invest the remaining $95 in a risk-free bond where the exercise price, and let's say this call option gives you the right to buy the same share for 100, okay, in 1 year time, okay, and when interest rates are 10%. Is it clear? So you have two options. For option number one, buy the stock with the $100 you have. Option number two, buy a call option where you have the right to buy the same share for $100 in 1 year time. The current interest rates are 10%. Okay. So let's make it x into 1 plus r raised to the power minus t is equal to 95. I mean, it will be around 95. Let me just get you the exact number. So it will be 100 divided by 1.05. So that is 95.24 approximately. Okay, and let's make this price equal to 4.76. So you see, your total investment here is 100. Your total investment here is 100. So should you go for this or this? Which option would be better? You don't know. Okay, so let's evaluate this. Let's suppose in future there are two possibilities. ST is equal to 80 and ST is equal to 120. So either this will happen or this will happen. So in the first case, if you have invested in your portfolio, your portfolio value will be 80 and you will lose $20. Okay, so it's a loss. If the second situation happens, your portfolio will be worth 120 and you will make a gain of here you are making a $20 loss and here you are making a $20 gain. Okay, this is with portfolio A. With portfolio B, what will happen? If the first case happens, this one, when ST is 80, will you exercise your call? Will you buy something for 100 that you can purchase in the market for 80? So you will not. So your call will expire out of money. So the call will be equal to 0. So there is no payoff from it. What will happen to the bond? It's a risk-free investment. So your risk-free investment will grow to the par value of the bond, which is 100. You know, you invested 95.24, and let's make this 5%. Let's make this 5%. Sorry for that. So it will grow to 95.24%, $95.24 at 5% for 1 year will grow to 100. So your payoff from this portfolio is 100, and if you look at your loss, it is 0. In this case, you are losing 20. So portfolio B is better than portfolio A, as portfolio B is enabling you to have no losses. What will happen to the second situation? In the second situation, your call will give you a payoff. You will be able to buy the stock for 120, that is ST, minus you will pay the exercise price, which is 100. So you will get how much? 20. And then what will happen? What will happen? X will be equal to how much? 100. So you know this 100 will come from this, so this will cross with this, so you will have the 20 payoff. So 20 is exactly the same as this. Now tell me which portfolio you will choose. Portfolio B is dominating portfolio A, isn't it? Imagine if interest rates increase to 10%. If you invest, if you are able to buy this bond, let's suppose if you do it like this, let's suppose the call price is 1 and you buy the bond for 99 and you get and you invest this at 10%. Let's suppose you don't invest in the risk-free bond, you invest in a bank account. So whenever interest rates are higher, what will happen? The value of this investment will be higher, and it will help you here. For example, if you had invested this amount here at 10%, you would have had more than 100 here, so it would be profitable. Similarly, this amount here would have been higher than this, and you would have had a higher amount than 20. So when interest rates are higher, this makes investing in calls more profitable than investing in the underlying stock. When interest rates are lower, then it's kind of like dull. So higher interest rates will make it more attractive to invest in the call options. So therefore, interest rates are considered to be positively correlated with call prices. So higher interest rates will make investing in portfolio B, that is investing in calls, more attractive than investing in the underlying. We have discussed the American call versus an American call and European call. So now we know that the American call value will always be greater than European call, or at least it will be equal to. But it will never be the case that the value of an American call is less than a European call. This is a rule you will follow throughout. We talked about that the intrinsic value of an American call is 0, maximum of 0, or S naught minus X, and the lower bound value of a European call is maximum of 0 or S naught minus X into 1 plus R raised to the power minus T. And we can see that because this is the present value, so this term will always be higher than this one. So we are saying that the value of an American call will always be greater than or equal to the European call, and then we have the lower bound value of a European call greater than the lower bound value or the maximum value or the minimum value of or the intrinsic value of an American call. So this looks or appears to be contradictory, but remember, as I told you, what European call can have, American call can have all of it. So the lower bound concept of a European call is also applicable to the lower bound value of an American call. However, the intrinsic value of an American call is not applicable to a European call. Okay, so that is the reason that it is not, you can say, a departure from what we have discussed. It is just to understand that the American call is as good as a European call and is better in that it allows early exercise. And we also discussed this point earlier. I told you, even though American calls can be exercised early, but they will not be exercised even if there are dividends, unless those dividends are significantly higher. And we will see that later when we talk about binomial option pricing model. So even in the presence of dividends, it may not be worthwhile to exercise an American call early. That is why the European value, the lower bound value of a European call, it becomes quite relevant for American calls also. We have already covered this. I told you that this is an important phenomena. In one of the reasons I quoted you that the present value of the dividends needs to be greater than the interest lost on the exercise price. And you now understand what I mean by that, because interest rates are positively related with the call prices. So if interest rates goes up, it will be more profitable to buy a call option and invest the remaining amount in risk-free investments than to buy the underlying. So if there are dividends on the stock that makes early exercise an option, you will have to consider whether those dividends have a higher value than the amount that you will, because when you exercise, what you need to do, you need to actually pay the exercise price, which you are already have deposited in a bank or in a risk-free security where it is earning interest. So if that opportunity cost is higher than present value of dividends, you will not exercise even though dividends have been there. Otherwise, you will exercise. And we already discussed effect of the interest rates, effects of stock volatility. Now, effects of stock volatility is, as I told you, we do risk neutral pricing. So what does this mean? In stock market and bond market and spot markets, I would just use the word spot markets. So in spot markets, if volatility is higher, we see the prices of stocks, bonds, commodities go down in the spot market. But in derivatives market, when volatility is higher, we see that the price of a call option or the price of a put option, they will always go up. So interest rate volatility, stock market volatility will positively affect the prices of call and puts on equity. And why is it so? Earlier we talked about, like, you see, you want to go to London, and I said if you have 10 minutes, uh, you can't reach there. But I didn't mention, the speed or the transportation that is available. So if we get Hyperloop, for example, or if we get Concorde or any other plane, will it not allow us to actually reach there in 10 minutes speed? So whenever you are talking about volatility in derivatives, my advice to you is don't talk about it like in terms of risk and other stuff. You just look at it, the speed. Okay, so you have to, if you want to reach London, there are two things that are important in that: time and speed. So and the speed depends upon which means of transportation you are using. So if there is more volatility, even let's suppose a stock price right now is 50 and the exercise price is 150, but the daily volatility of the stock is, let's suppose, 80. So, and let's suppose the time to expiration is 4 days. So we can expect this stock to cross 150 in 4 days given this. A very good example right now is the Bitcoin market. The volatility in the Bitcoin market right now is 80%. I mean, like, if you look at how the price has behaved. So if it is trading at around $48,000 today, and you have an exercise price of $60,000 in 5 days time, there is a high likely chance that you will reach there. But if you are trading in Tesco's share, and the Tesco's share right now is, let's suppose, 300 pence, okay, and the exercise price is, let's suppose, 380 pence, and the daily standard volatility is 5 pence. You can't expect yourself in 20 days to be actually closing on this. The pricing of put options is the opposite of what we have discussed for call options. So we don't need to actually put an extra effort. It's just that you have to understand that, for example, the intrinsic value of a put is just the opposite of what we learned about the European call. So the intrinsic value of a European put will be the maximum of 0 or x naught minus, x minus s naught. Okay. And like we learned for the call option, the value of any, let me just write this, P. The value of any put will always be equal to or greater than 0. Whether it is a European put or American put, it will always have a value equal to or greater than 0. For American put, we will have the intrinsic value equal to maximum of 0 or x minus s naught. So the concepts, all other remains the same. The same thing as we discussed, that the European, this will be the American, sorry. The European put will not have an intrinsic value. It will have a lower bound value, which you will learn in the same manner as we learn the call, again, portfolio concepts. And again, the price of the put will be a combination. For example, for the American put, it will be intrinsic value plus the time value of money. And it is possible that all the value is coming from intrinsic value, or all the value is coming from time value of money, or a combination of both intrinsic value and time value of money, depending on whether it is deep in the money, out of the money, or at the money. Similarly, the maximum value of a put for European put, the price of a European put will always be greater than or equal to, less than or equal to less than or equal to the present value of the exercise price. Okay. Why? Because you cannot exercise early. Let's suppose I purchased a put option with an exercise price of let's suppose $100 on Apple. Okay. And Apple's share right now is at $135. Now this option is expiring in 1 year time. How high the price of the put can be? Forget about it being European or American put. This depends upon how low can the stock price of Apple go. The maximum loss that can happen in this case, if somebody purchased the Apple's share, is that the stock price goes to zero. Let's suppose in 6 months time. That means Apple has become bankrupt. Okay. So in case of bankruptcy, what will happen? The stock price will go to zero. If I have the right to sell Apple's share to you for 100, what can I do? I will purchase it from the market for zero price and I will sell it to you for 100. So the maximum I can get or I can gain is $100. If it is an American call, I can exercise it at any point of time, and that is why for the American put, I will have its value less than or equal to X. But this is the theoretical boundary. Okay. However, for European put, what will happen? I know that I can sell Apple's share for $100, but the problem is it is only 6 months and I can only exercise after 1 year. So I will have to wait for another 6 months. So that is why we see that I have to calculate the present value of the exercise price, because even if Apple goes bankrupt and I have a European put, I will have to wait for 6 months more to exercise my right. Okay, so this is why we have these two differences. Then the value of a put at expiration, whether American put or European put, will always be equal to the maximum of 0 or X naught minus ST. Okay. And this is the same as we talked about for calls. The same logic. The only thing is the right to sell rather than the right to buy is involved. Then, of course, the effect of time to expiration, again, the same conclusion. The option that has the longer time to expiration will be valued more than the option that is having shorter time to expiration. And again, we will see the put option that has more time to expiration will be valued more than the put option that has less time to expiration. The logic remains the same. And it cannot be proven for European puts. Remember, when we were talking about American calls and European calls, I told you that this could have been proven. For example, we said that C2 will be greater than or equal to C1 for American call. And we said at that time we cannot talk about it right now unless we talk about the lower bound value of the European call. So for European call, it will also be the case that C2 will be greater than C1 once you can't understand the concept of the lower bound of value. So you will see that the lower bound value of C2 will be the maximum of 0 or S naught minus X into X1 X into 1 plus R raised to the power minus T2. Okay, and then the lower bound value of the what we call the other call will be the maximum of 0 or S naught minus X into 1 plus R raised to the power minus T1. So you can see if this is discounted, everything else is the same. The only thing is the T1 and T2. So this is more time. So the present value of X will be quite low here. So therefore the value of this option will be greater than the value of this option, or maximum 0, provided both the options are deep out of the money. Okay, so we can prove this with European call also. However, the same is not true for American put and European put. So this is only true for American put, but not for European put. Okay, and the reason for that is we know that the longer the time to exercise, the longer put is both advantageous and disadvantageous. Okay, why? Because it will have more time value of money if it is having a 6 months maturity relative to P1, which has 3 months maturity. However, the problem is that in the case, for example, let's suppose if you have a European put option, okay, put option European 1 and put option European 2, this gives you the right to sell at $100, and this gives you the right to sell at $100, and this is expiring in 2 years, let's suppose, and this is expiring in 1 year, and this is expiring in 2 years. So let's suppose if the stock of Apple becomes bankrupt and ST of is equal to 0, what will happen? The maximum you can gain is $100. Now this $100 here, you will have to only wait, let's suppose, for 1 year, and here you will have to wait for 2 years. So the present value, if you look at the payoff, will be like, you see, maximum of 0 or x into 1 plus r raised to the power minus t2, okay, minus s naught, and this will be less than maximum of 0 or x into 1 plus r raised to the power minus t1 minus s naught. So you see, whenever it's a European put, you will have to wait a longer time period to receive your gain from the put option, like in our case when we said that the Apple goes bankrupt, and here you will have to wait less time. So therefore we cannot prove the same for European put option. Okay, the effect of the exercise price, same logic as we discussed for call option, just only it is the right to sell. So you will have to have a look at it and let me know if you have any issues with this. It's the same concepts involved. The same concept as we discussed for call option, the same concept is involved here. And again, we don't need to repeat it. You just have to read it. And if you have any issues, you can come back to me on that. Similarly, we have the lower bound value of the put option, and you can again use the same logic as we used for call option. So you see, instead of we having here a call option and the present value of a bond, we have the portfolio B, which comprises of investing in risk-free bond, where we have a long position and where we have a short position in the put option. So you can use this portfolio A and portfolio B to see which portfolio is dominating. So in both the cases, we see that portfolio B is dominating portfolio A, which means that the value of the portfolio B, which is x into 1 plus r raised to the power minus t, minus PE into S naught, T, and X. Sorry, portfolio B is being dominated by portfolio A, will always be, because you see ST is greater than or less than X. So you see in this case, ST is more than X. So when this happens, it means portfolio B is being dominated by portfolio A. So will always be less than or equal to S naught. So if you rearrange this, what you get is that the value of the put option will be what? It will be x into 1 plus r raised to the power minus t minus s naught. This will come to this side and that will come to that side. So it will become the value of a put option. In this case, it will be the lower bound value of the put option, European put option, with a given exercise price and time to expiration will always be greater than or equal to the difference between the present value of the exercise price and the stock price. As we discussed for American calls and European calls, the price of an American put will always be greater than the price of a European put. It can never be the case that the price of an American put is less than the price of a European put. The same logic applies as we discussed for American calls. Okay, and early exercise of an American put. So American puts can be exercised early if the stock goes into bankruptcy. In that case, that is the maximum you can get. So there is no point in actually waiting further. So American puts can be exercised prior to expiration, provided the price goes at a sufficiently low level, and the extreme situation would be when the price is 0, that is, the company becomes bankrupt. On the other hand, dividends will positively affect the value of a put option, So the price of the put option will be always um, positively affected if there are dividends, because dividends will reduce the stock price, and the stock price reduction will increase the put price.